Well, I'm joined now from our Melbourne studio by Leith van Onselen, a former investment banker who writes under his nom de plume, The Unconventional Economist. And with me here in the studio is Roger Montgomery from Montgomery Investment Management. Gentlemen, welcome.
Thank you. Nice to be here.
Thank you.
Well, Leith, if I could bring you in first from Melbourne there. 4 weeks now we've been hearing about this higher costs of funds and banks doing it tough. Just heard about NAB. What are the chances of an out-of-rate cycle rise? And are the banks justified?
I think the chances are quite decent. There's absolutely no doubt that the bank's cost of funding are rising. And one only needs to look at the recent bank-covered bond issues, which have raised funds at around 6 to 7%. Now, if you compare this to the discounted variable mortgage rate, which is currently at around 6.5%, there certainly isn't a lot of margin for the banks to lend profitably right now.
And they're also increasing competition, they say, on the deposit side. So we've even got banks like Bendigo and Adelaide saying that they're going to potentially go against the cycle.
Yeah, absolutely. Well, I was actually on the internet today, and you can still pick up a term deposit for 6.1%, which just shows you the level of competition out there.
Roger Montgomery, what is this actually saying about what's going on in the economy?
Well, it says a couple of things. Firstly, it says there may not actually be enough competition in our banking sector. If the banks are beating their chests as hard as they possibly can, effectively warning investors, particularly mortgage holders and business owners, that rates are going to go up out of cycle, then it means there isn't enough competition. And it also says to me that monetary policy in Australia now will become less effective. It'll be a much blunter instrument than it's already been, because what will end up happening is through the open market operations, the banks will actually, the RBA will cut rates in an effort to stimulate the economy. It won't work because the banks aren't passing it on, so they'll have to cut again and again and again before there's any effect on the economy. So the instrument that they're using to actually manage the economy, particularly inflation targets, is less effective.
Let me pick up with Leith on that competition point, because this idea of the banks being, the big four banks being too big to fail now, we've got this implicit guarantee. I know that on ABC's Online Drum there's a good article by Mark Burris and Christopher Joy, and they talk about a trade-off between competition and financial stability, which ends up favouring a more concentrated industry. Do you agree with that?
Yeah, I do actually. Certainly, there is definitely a trade-off there between competition and financial stability. I believe that the Treasurer Wayne Swan is actually towing a pretty fine line when he tries to request that the banks pass on all the interest rate cuts, because banks will only lend where it's profitable to do so, and if you squeeze them too much, they'll simply stop lending.
So, Roger, do you go on? Yes,
well, let's say this: they're not lending. Cameron Klein came out today and said it's the lowest rate of mortgage growth that he's seen since 1976. But more importantly, whether it's Wayne Swan or anyone else, it's politically expedient to bat for the battler and to say that that the banks are the bad guys. It doesn't matter where we are in the political cycle; they're always going to say that. So just keep that in mind.
So do you actually have banks on your books in your fund?
Well, we have owned the banks. We don't at the moment. All of the banks.
Why not?
Well, the ANZ and the NAB are the cheapest for us. They're trading at about a 10% discount to our estimate of their intrinsic value, but that's not enough of a discount for us to describe them as a bargain. So we would like to see deeper discounts to our estimates of value before we would buy them for our portfolio.